Okay, welcome to the first module in the Workplace Savings Scheme Trusteeship series, Introduction to Trusteeship. My name's David Ireland. I'm a partner at Dentons, Kensington, Swan. It's a pleasure to help run you through some of the technicals in this first aspect of trusteeship. Co-presenting with me today is Philippa Kalasih from Mercer. Philippa, you'd like to say a couple of introductory words?
Thank you, David. I'm a client relationship manager at Mercer, and I provide scheme secretarial services and also superannuation consulting services to trustee boards. One of the areas I'm really passionate about and enjoy doing is engaging with trustee boards to help them understand their roles and the obligations that they have. So this is a great training module to get started, and I'll hand over to David to take you through the learning outcomes for this session.
Thanks, Philippa. Yeah, look, Philippa and I have worked together over the years quite a bit, trying to assist trustees really get to grips with what they need to be thinking about in administering a scheme without turning them into legal experts, etc. Because then I'd be out of a job and Philippa wouldn't have as much to do on the administration side, right? So really the objective of this module, bearing in mind this is just the first in a series of modules, is just to get trustees, provide trustees with a bit of an introduction overlay to what they need to be aware of with their role as a trustee of a restricted workplace savings scheme. So by the end of it, we'd like to think you'll be able to place a scheme that you are looking after in context, understand the scope of all of your responsibilities without necessarily knowing the intricate details. You'll have a handle on the legislative framework that you operate in. You will know your FMC Act administrative obligations, and Philippa's going to work through that with you. Don't be daunted at this point. We're not going to go through every provision of the Financial Markets Conduct Act because that might take several days. So we're just going to give you a highlights whistle-stop tour of the key things you need to know about as a trustee. And we'll also just touch on some of the other legislative obligations that you need to be aware of, but again, without getting into too much detail. Right, so let's rip into it. First up, what is a workplace savings scheme? So bear in mind, this scheme, all schemes are just a form of trust. A bit like a family trust, it's just a particular type of trust that you are looking at. As a trustee of workplace savings scheme, you will be the trustee of that trust. It could also be, I guess, a standalone trust, or just an employer plan within a master trust structure, which operate as a form of sub-trust for any of you a bit more familiar with the concept of a trust at all. A restricted workplace savings scheme will be governed by either a board of individual trustees, or in most cases, it'll be a corporate trustee, and you might be a director of that corporate trustee. As a trustee, you're going to be responsible for investing and administering the scheme assets. You must do that for the benefit of the beneficiaries, but always acting in accordance with the terms of the trust deed. No matter how much you want to do something, no matter how good it might be for the members or the employers participating in a scheme, if it isn't permitted under the trust deed, then you've got a problem. It's not an excuse to say, this was a great idea, this was going to be helpful for our members. If it's in breach of the trust deed, then you're in a breach of your obligations. So one of the key mantras through this is always follow your trust deed and the law. If you do that, then you're going to be in a pretty good space. The members are your primary concern as the beneficiaries of the trust, and that's what you always need to bear in mind when you're administering your powers. Is this going to deliver a good outcome for the members in relation to whatever you're doing? Okay, let's look at, I guess, the broader context within which schemes operate. Unlike a family trust, your workplace savings scheme has got this commercial overlay. Most significantly, in most cases, beneficiaries or the members, the employees in question, are contributing or will have contributed their own money to that scheme. So they have more of a direct interest in what is happening with it. You need to consider the interests of the investing members, pensioners or retired members or deferred members, whoever you might want to categorise members who are no longer in the workforce. They might be the scheme's, the trustee's primary consideration, but always bear in mind your participating, sponsoring employers are also key stakeholders that they don't control the cards. They're not in control of it. It's you as trustees that need to be doing the right thing by the scheme members. The employment context is also an important one to bear in mind. The scheme will often represent the direct financial outcome of a member's working life. That means there's a bit of an overlay of the employer's duty of good faith in the way that the employer exercises their powers in relation to a scheme, and something that trustees also need to bear in mind as they go about exercising their powers. In addition to the commercial context, we also have the regulatory context, and this has been my bread and butter for the last 30 years of practice. And it'd be fair to say that the regulatory context in which you operate has become increasingly complex and more involved over the past 30 years, in particular since the Superannuation Schemes Act 1989 was passed. The world has got a whole lot more complicated. We also have a lot more guidance around how things work, so it's not something to be daunted by, but there is quite a lot to be aware of. Most significantly, we've got the Financial Markets Conduct Act and the Financial Service Providers legislation, so the key framework things to work around. You've also got a bit of overlay from the KIWISAVER Act, our good old friend, the income tax legislation, and a whole raft of related regulations under that. It's not just about the Financial Markets Conduct Act, though. We've also got a range of other pieces of legislation that will impact upon the day-to-day administration of your scheme to varying degrees. But look, we're not going to go into the detail of those. That's just a general overlay. I think, Philippa, you were going to jump onto the next bit of talk to us about the various people who are involved in operating a scheme.
Thank you, David. This slide is really useful to understand all the parties that are involved in the management and contribute to your scheme. So if you look around the diagram, you've got the trustee in the centre. You work around, you've got the employer, the sponsors, other stakeholders. Of course, you've got the members, pensioners. You've got your licensed independent trustee, your secretary, admin manager. You may also have a communications consultant for your scheme, investment consultant. You've got the investment fund managers, legal, taxation, accounting. You're also required to belong to a dispute resolution scheme, and we have registers that you must be part of, and one of those is the Financial Services Provider Register and the Disclosed Register, where Disclosed Register is your key register for all the important documentation, offer documentation and scheme documentation. And right at the top there is the FMA, and they're obviously critical in this. And also they're very engaging and happy to be involved with trustees. So it's important that this range of parties interacts well to ensure that all these obligations are met. Your providers are appointed to help you, and they're actually paid to provide a service and help ensure those obligations are met. From my experience, the most effective boards are those that treat all stakeholders as being part of the same team. So David will now take you through the responsibilities of the trustee.
Yeah, I think that's a really good point, Philippa, just while we're on that slide in terms of operating as a scheme. I think where schemes, in my experience, have tended to perhaps unravel a little bit is where you adopt an adversarial approach, or there's a bit of toing and froing or positional play between the various stakeholders. Why we wanted to put all that on the one slide was just to demonstrate we're all in this together, and actually the best operated schemes are the ones where everyone is in the same waka and paddling in the same direction, rather than try to paddle in for their own interests and going in different directions. If you can just get that communication between all the stakeholders operating effectively, then your scheme is going to be in a good place. If you take away nothing else from this session, hopefully you will, but if you take away nothing else, it is that importance about communication between all those sets of stakeholders, and having an effective administrator admin set up to support your schemes probably is a key fundamental there to make sure all that happens. Right, I'm now just going to rip through, I guess, some of your standard responsibilities as a trustee. Most of these responsibilities are actually ones that you will have as a trustee of a family trust as well. It's pretty much the same set of law. We've got the Trusts Act sort of coming in, or a new Trusts Act that will take effect from the end of January 2021. And a lot of those duties are also flow through to you as trustee of a workplace savings scheme. First one I've touched on already, of your obligation to always operate within the terms of the scheme's trust deed. Your primary obligation as a trustee, looking after the scheme assets for the benefit of the members, which will require you to invest prudently and to pay the benefits to the right person at the right time. At the end of it, it's not just about looking after the scheme assets. The overall objective is actually to be paying out the sum of a person's working life to them in the form of a retirement pension, lump sum benefit, whatever your trustee provides for. You are required to carry out your duties with reasonable care in good faith. I've often been asked, what does good faith means? The main legal definition is not in bad faith, and you need to operate impartially between beneficiaries. However, if the trust deed allows you to provide particular treatment for one set of members as opposed to another, then that's fine. Impartiality doesn't mean, I guess, true, unfettered impartiality. You just need to exercise the powers under your particular trust deed on an impartial basis without fear or favour. Last, there's a general trust law not to profit from the trust and avoid conflicts. In a restricted scheme with member and employer union appointed trustees, these conflicts are always inevitable. The key thing there is to actually recognise those conflicts and deal with them appropriately. You've also got rules under the trust deed that will modify the default position at law. And there'll be a little bit more on these sorts of issues under the Restricted Workplace Savings Schemes governance module, which you can also look into at a time of your choosing. Right, when we come to discretions, key thing with discretions, these are where you need to make a decision, right? Where you've got a choice as to what you need to do, as opposed to a power of something that you must do. So where you've got an operative decision, and say it might be you've exercised the discretion to choose your lawyer, right? So that's something, it's a discretionary thing as to who you choose to get your legal advice from. To exercise that discretion to get advice, I guess, promptly. You're doing it from time to time. I always look at, have I got the right support there? Have I exercised my discretion appropriately? So don't just set and forget things. You do that again in good faith, and you take into account all relevant and no irrelevant factors. So in that legal provider's example, a relevant factor is whether or not your legal provider actually has some expertise in relation to the FSC Act, say. An irrelevant factor would be that I play bowls with the lawyer in the weekend, right? In terms of friendship type things. So just thinking actually, what are relevant considerations taken into account? Make sure that there is nothing irrelevant when you're exercising a discretion. You obtain expert advice as necessary, but you guys are the ones that are in charge. It's always your decision. Take advice, but at the end of it, it is only advice. The discretions, etc., how you go out exercising them is the second module in this series that can become available in due course. We get into the nitty-gritty of making decisions. Right, we've got general administration obligations. Philippa's going to touch on these a little bit further in her section. But key thing, financial statements, need to make sure we've got those. You've got an annual report you need to produce each year. For some schemes where you're operating on the principle of unallocated funding, primarily that's schemes that are providing pensions, but there's also a few schemes that do have benefits that are calculated that do require actuarial support for the way they calculate their benefits. You'll need an actuarial valuation to make sure that you are satisfying solvency obligations. You need to keep decent minutes, and you need to make sure you're properly exercising your delegations. And of course, my favorite, you must always comply with applicable regulations. There is, of course, a risk that something will go, that you will have insurance benefits in the benefits that are being provided. So key principle to follow when you have got an insured benefit under your scheme, do make sure that your risk benefits are fully insured, which primarily comes down to making sure that your risk, the benefit under your scheme. Like, let's say you've got a disablement benefit being provided under your scheme by its trustee. You need to make sure that your policy wording for when a benefit will be paid out under your policy actually matches the disablement benefit that you have got under your scheme trustee. Otherwise, there is a problem, and the members might be looking to the trustees if there is a gap in that cover between what the trustee is supposed to provide and the insurance cover you have been able to access. Bear in mind that your cheapest cover might not be the best, and you cannot abdicate decisions to the insurer. So unless the trustee actually allows you to, generally it's going to be the trustee's decision as to whether or not a benefit is going to be paid out. Hopefully your decision will match that of the insurer. Liability, which was, I was getting ahead of myself in the previous slide, sorry. If something goes wrong, somebody will be called to account, right? If you breach the terms of your trustee, it's sort of the trustee equivalent of breaking the law. The main risk is personal liability. So i.e. the members look to you because they have suffered a loss, and therefore as a trustee recognise that things can go wrong. How do you protect yourself? Primarily what you're looking at, you've got some statutory protections for your position. Your primary source of protection from liability will be what is in the trust deed. So that will generally define, set up your liability. Your responsibility as a trustee will usually be limited to the assets of the trust unless you have breached the terms of your trust deed. If you do something that was not permitted under the trust deed, the law says that it is not fair that the scheme should protect you from the consequences of you breaching the terms of that trust deed. Normally you're going to have looked to insurance cover to protect yourself against that eventuality. And one of the key things you should be doing as a trustee once you leave the seminar would be just to check out, hey, what is my D&O, Directors and Officers Insurance Cover? What is the protection position? Have I got, say, an indemnity from the employer sponsor in relation to my position? What happens if something goes wrong? The other key way you can protect yourself from liability is in the terms of your contractual engagement with any third party. Usually what you're looking at when you contract with somebody is to include a limitation of liability provision in the terms of the contract, so you're not exposed beyond the assets of the scheme. Right, that's the little whirlwind tour of your general trustee obligations. The next bit is the fun bit where we do get to the Financial Markets Conduct Act and our legislative overview of what governs your life as a trustee of a restricted workplace savings scheme. The first bit, fundamental under the FMC Act, is you need to be registered. There's a range of registration options under the FMC Act. Not all schemes are created or regulated on an equal footing. There's a number of prescribed requirements. Above all, for any scheme, no matter what type, the fair dealing provisions of the legislation will apply to you. And that applies actually whether you are registered or not. The schemes that aren't registered are generally a wholesale schemes. So many of you as a retail scheme will invest up into a wholesale scheme. Those ones have a much looser set of regulation around them. But the comfort for you as a trustee is, hey, fair dealing provisions will apply to them. Now, Philippa, I think you were going to talk us through this slide, just the range of registration options, yeah?
Thank you. This wiring diagram shows the types of retirement schemes and then the categories within each stream. The key focus for this audience are the green boxes along the bottom of the diagram. On the left-hand side, you've got the standalone employer-specific restricted workplace savings schemes. And these have the corporate trustee or individual trustees with a nominee company. You have your licensed independent trustee, and they may be one employer or a group of related companies. The middle box there is the industry-based restrictive workplace savings schemes. And these are where different companies join together to form a scheme. A couple of examples are the dairy industry and the meat industry. And they both have industry-based schemes, and also local government. The last green box there are employer plans that sit within a master trust. So instead of running their own scheme, the employers work with a provider that looks after the compliance and management of the plan.
Cool, thanks, Philippa. We are going to hear quite a bit more from Philippa as we get into some of the nitty-gritties. Just doing the overlay before we get into that. You call this the warm-up act, right? About the FMC Act. So I thought it might be helpful just to look at a bit of an overview of the way the Financial Markets Conduct Act works, sort of a descending order of priority. Although don't take that the wrong way that I've put the Financial Markets Authority at the bottom of that slide. I hadn't thought through those optics, never mind. Look, at the top, we've got the legislation, right? The Financial Markets Conduct Act. That provides the framework, including some of the specifics that you must have in your trustee, obligations for supervisors. We'll talk about that separately. Your key statutory obligations all sit in the FMC Act, along with some very high-level type register requirements. The real nitty-gritty, the nub of it, is in the Financial Markets Conduct Regulations. These are things that have been passed under the FMC Act, and they run through your specific requirements in more detail. And in particular, say if your scheme is actually open to new members who can still join it, one of the key things to be looking at there will be the product disclosure statement, your disclosure obligations, very tightly prescribed, quite detailed. Both of those two pieces, the Act and the regulations, are quite complicated reads, unfortunately. It's something I don't recommend for your bedtime reading unless you have particular issues with getting to sleep. It's quite complicated, very prescriptive, complex things to work through. Hopefully you've got good administrator, legal advisors, etc. to support you through that. Probably from a day-to-day basis, you don't really have to interact too much with these pieces of legislation. You just need to know that they are there and know what your key obligations are under it. The detail is complex even for those who specialise in this stuff, and you get advice, get support to make sure that you've got it right and it's all under control. The third box there is the disclose register. Philippa mentioned that before. That's the key register for you where you have your scheme registered, and if it's open, you'll also have an offers register, which is where you'll find your product disclosure statement and other offer documentation. The key regulator that you're going to interact with in relation to the operation of the scheme is, of course, the Financial Markets Authority, or the FMA. So they're responsible for issuing frameworks and methodology. They also issue quite a lot of guidance to support. I think that we are very well served in the New Zealand sector with the FMA and just their whole knowledge, really approachable. If you've got any issues, we are in a very fortunate position. You can just pick up the phone, talk to the FMA, talk them through it. I think one of the key things there is, if you do find you've got a breach or an issue where you're concerned about how things are going, in our environment, it's you pick up the phone, you get it sorted, and generally it's all about getting to a solution. Not quite the same perhaps in some other jurisdictions, but in New Zealand we do have that advantage and something to make sure you make use of. Schemes, all schemes, so we have to maintain a Financial Markets Conduct Act compliant trust deed. As a non-restricted scheme, and Philippa's mentioned this a couple of times before, we have to have a licensed independent trustee, right, as a restricted scheme. So that might be reflected in your trustee composition clause within your trust deed. Most schemes that have come across with trust deeds now will have that locked in. One of the trustees or one of the directors of a corporate trustee must be a licensed independent person, i.e. somebody who has been licensed by the FMA. What the FMA is saying, this person has particular expertise in being able to co-regulate, keep the trustees of a restricted scheme on track. Contrast that with a non-restricted scheme, which is the second bullet point on this slide, where your normal retail scheme will have to have a licensed independent statutory supervisor. And for them, they have the added regulatory overlay of the manager of those schemes, which really is the equivalent of the trustee of a restricted workplace savings scheme, also has to be licensed. So that's one of those areas of confusion that you might get when looking at the way schemes operate, is that as a restricted scheme, the trustee is referred to as the manager in the legislation. And so whenever you hear anyone talk about the manager, you think, well, do they mean either our administration manager or the investment manager, or actually is it us as the trustees of the scheme? We're responsible for its management. Whereas with the non-restricted scheme, you've got your licensed manager who's doing all the day-to-day operation. Then they have a statutory supervisor. It used to be called a statutory trustee, now a supervisor, recognising they're not so much a trustee. They have oversight of the way the manager is discharging their obligations. All schemes have to have a custodian, although if you've got a corporate trustee, you can be your own custodian. The custodian is the entity that holds the assets of the scheme. So all scheme assets will not or should not be recorded in the name of the XYZ Workplace Savings Scheme. Instead, it will be recorded in the name of XYZ's savings scheme custodian limited or something like that, right? So it's a separate custodian that you appoint that holds the assets for the scheme. There is a bit of interplay between KiwiSaver and superannuation. Won't go into this in too much detail. Again, it's perhaps something you could deep dive in and get a whole lot more information about it. But the way workplace savings schemes have responded to KiwiSaver, a few schemes, quite a small number, I think, Philippa, there's quite a limited number of schemes have incorporated complying superannuation funds within them, which does add a bit of complexity, but effectively it's bringing KiwiSaver within a scheme. If you are in a workplace savings scheme, KiwiSaver scheme, and there are a few out there, including a couple that operate as restricted schemes, the legislation will dictate your contribution and benefit design for the scheme. Of course, those constraints do not apply to workplace savings schemes. You have freedom to determine your benefit design, of course, subject to some constraints under legislation as to restrictions on the benefits that can be paid out in order to get your criteria, your status as a restricted scheme. A lot of schemes have had their design contribution arrangements primarily adjusted in response to KiwiSaver contribution obligations to make sure there isn't a double dipping by members of the scheme in relation to their employer contributions, and also to recognise that if an employee is already contributing 3% to a KiwiSaver scheme, maybe requiring them to contribute another 5% to the workplace savings scheme or whatever is more than some will be able to handle. Always think about, yes, how does my scheme respond to KiwiSaver type contribution obligations? Let's think. Go on to the next one. Contents of the trust deed. The legislation does dictate what needs to be in your scheme to a limited extent. Normally, I think as a trustee of a scheme, you are unlikely to come across these provisions too much in practice, just that they are there. Your trust deed is required to provide adequately for a certain range of things, with some additional constraints for KiwiSaver schemes, super schemes, and this category of scheme that we're particularly looking at here of workplace savings schemes. So disclosure used to be an investment statement back in the old days. Before the Securities Act applied to schemes, it was the member booklet. This is your primary source of member information for those who are wanting to join a scheme. So what are the rules? How do I contribute? What are the risks? What are the benefits? Who's involved in it? That sort of thing. It's very heavily prescribed, including word and page limit for what can be in your PDS. It must be received by a new member before they commence membership. So your key regulatory concern there is, have I got systems in place to make sure that every member joining my scheme has received their PDS? For master trusts, what you'll find is your PDS will usually have an employer-specific supplement that sets out the particular rules that will apply to that particular plan within the master trust. We've got a whole lot of register entries on Disclose that will support your product disclosure statement. The most significant being your other material information, which supplements the information you have disclosed. That's also where you will find your fund updates. That Philippa will be talking about shortly. So I think now we're over to you, Philippa, to talk about all these specific obligations under the FMC Act that administrators need to keep on top of.
Right, so under the FMC Act, you do have a number of obligations, which has come up a few times throughout the presentation so far. Now, we've listed out some of these, but it's not a complete list. So over the next few slides, we'll be running through these obligations and just highlighting a few points to watch out for, and also some learnings that we have found over the years since the FMC Act came into force. So you've got listed there the related party transactions is the first one on the list, and we'll go over to that now. Thanks. Right, a related party benefit is a benefit that is given out of the scheme assets or creates an exposure to loss for the scheme and is given to or received by a related party of the scheme. So when you look at the related parties, your administration, the trustee, the administration, the investment managers and their employers and are associated related parties. Now, you can't enter into transactions that confer these related party benefits unless you've got a certification, which is a form of exemption. So, and these are required to be reported to the FMA at the end of each quarter, and sometimes it will be a nil report. So what's really important is that each time you enter into one of these transactions, you at the same time complete that related party transaction certificate. It doesn't include fees or expenses that are paid by or reimbursed to the trustee in accordance with the FMCA or the trustee. So you enter into these, you consider these certificates on an ongoing basis, check is everything covered, is there anything that should be included? And there's different ways that you can go about reporting. Some trustee boards will have an enduring type certificate whereby it's updated in full and it records every related party, and others will just prepare a related party certificate just for the transaction that's occurring. And when these are submitted to the FMA, it's important that you attach evidence. So it might be a letter of engagement, statement of work. When you have a big document like a new services agreement, you might want to check with the FMA whether they want to receive the full document or just the certificate in that instance. So these are normally signed by 2 of the trustee directors or trustees, and the LIT must consent to the certificate. So we make sure that the LIT is one of those signatories as it goes through. So limit breaks are set out, there's limits set out in the SIPO, and when you have a material breach of those limits, then it triggers a reporting obligation, and the timing of that reporting depends on what has occurred and how quickly you're able to fix it up. So, and the reporting is to the FMA. So it's really important your SIPO details the types of investments and any limits on proportions of each asset type. And also if you've got no limits, that's actually stated in the SIPO as well. It's important that you have a really clear understanding as to what a limit break is. And if something occurs, consider the size of it, the losses to the scheme participants, and whether it's a one-off or a pattern of events, and the impact on members. And in all instances, David mentioned earlier, engage with the FMA. They're very approachable, they want to know. So if you have a limit break, material limit break that is not corrected within 5 working days after becoming aware of it, then you must let the FMA know immediately. Regardless of this, a lot of trustee boards would decide to engage with the FMA anyway, even if it is fixed at that period. So you are required to report on it, and those immediate reporting ones, if it's not corrected, you report. at the time, but you also include that in your quarterly reporting at the end of the quarter. If you have a limit break that is corrected, you're not required to report it straight away, but you must include it at the end. So you have a continuous obligation to report these, and there's very much a prescribed manner in the way that you report it. And there's a guidance note there, information sheet, and they're really useful and just walk you through what is required in the unlikely event, or likely, that this may occur. So looking at fund updates, these are required annually for every fund or investment option within a restricted scheme, and they must be published within 3 months of the year end. So publishing may be on your scheme website, or if there isn't a website, you would then mail it out to all members of the scheme. And then within 5 days, you must file that on the Disclose register. So this includes if you have life cycle stages and multi-fund, everything needs to have that fund update. Most defined benefit schemes do not need the fund update. So in general, it's your defined contribution schemes and just a very small portion of the defined benefit schemes that have benefits that are based on the earnings throughout the year. So closed schemes, we note there, still need to provide an annual fund update requiring a closed offer register entry. It's really important that you include in the process due diligence and ensure that you've got some kind of statement of accuracy or statement from your provider for all the information that they've put in there, because you have the same liability that you do on the fund updates as you do with the product disclosure statements, and it cannot be misleading or deceptive in any way. So as you're doing these fund updates, also turn your mind to your product disclosure statement, because in that product disclosure statement you've got risk indicators, so you're updating them at the time you do your fund update. Have a look, check your document and make sure that it's correct. And then
it's probably one of the key differences, sorry Philippa, just between a restricted scheme and a retail scheme, where these fund updates are quarterly. So you'll often think you'll hear of the quarterly fund updates and you think, well, I'm a workplace savings scheme, why am I not doing these things quarterly? It is the same, it's pretty much the same type formula. It's a few additional things because it's an annual fund update, but actually for a retail scheme, so most KiwiSaver schemes, you'll be doing this quarterly fund update. The fact that you've got this, let's think, I guess an annual fund update doesn't change the fact you still need to look at or consider your risk indicators every quarter. I think we aren't really going to touch on that in detail because that starts to get a bit more complex. We might look at that in a further module, but even though you're only looking at fund updates on an annual basis, I think every trustee meeting, most schemes I'm associated with, they will actually look at, well, hey, what's the investment report? What's our risk indicators doing? Are there any big changes? Because that may impact upon what we're doing with our register entries and our PDS as well.
And actually, just one more thing on the fund update. There's 2 parts to it. You've got an Excel spreadsheet, and then you've also got the Word document. And the Word document is very heavily prescribed. And there's certainly some sections of that, David, I'm sure you get a lot of comment on in your world as to the relevance. But the idea of the fund update is that it provides some kind of comparative document between schemes. But in the restricted space, it's a bit of an anomaly.
Let's not go there. Right. And annual confirmations.
Right, so in the old days, we had member benefit statements. So these have now been renamed as annual confirmations, and these are provided on an annual basis to members of the restricted schemes. And we've got a note there about, they're provided for all schemes, so whether it be KiwiSaver or other retirement schemes as well, the content and the frequency of those will differ. But in terms of your restricted scheme, you've got 3 months to issue this statement from your balance date. So that's actually a really, it's quite a challenging time, and when you're working on your financial statements there in your report, and you've got to get this information out, and definitely that timing mismatch. You've got 3 months for this, but 4 months for those other reporting. And so where you've got interest rates, credited interest rates, they often require those financial statements to be signed off and or at least final audit clearance before you're able to issue that annual confirmation. So the information is provided to members and they can ask for it at any time. And where schemes have websites, they're often shown on the website and members can go back and look at those. So on an annual basis, if your scheme is open to new members, you also need to work through the PDS confirmation process. So at the time that you do this, it's really important, once again, that you look through everything within your product disclosure statement. It's often a good time to look and see whether there's been any changes during the year that would impact in terms of regulation changes. Is there a bit of a tweak here needed? And look for those timings and the risk changes in the risk indicator and fees, and just review it as a complete new document each time. You can replace your PDS, but it's actually the annual confirmation that you're loading. So if you're going to replace your PDS at the same time, you would also have a consent to lodge that PDS. So I mentioned earlier about the financial statements and annual reports, and these are required within 4 months of the end of the year. We used to have a little bit longer to do this, and I must say, start the process early. Preparation is key. So your provider will help you with bringing together the content of the report, and there's a number of steps that it needs to go through. So the auditors will often want to have a review. Legal will often review the report, and then of course it goes through the trustee board a number of times. And they vary in content and scope, but there is a statutory section, and that trustee statutory section is basically the trustee making a number of certifications and setting out the key changes that have occurred during the year. And this includes changes to SIPO, changes to the trustee board, and just detailing out a summary of all that contribution and membership movement. So I've got a learning there. Definitely do not underestimate the time it takes to prepare your annual report. And if your annual report is going out with your annual member confirmation statement, then you need to ensure that it goes out within that 3 months. You don't get added time just because you're sending them out together. So I've mentioned there about the content requirements, statutory and technical. And the last point there is not a need to include the summary financial statements, and that can actually free up the process. And in fact, most of our trustee boards have decided to remove those, and that means you don't need a full audit and audit certificate in your annual report, which is definitely a good move, isn't it, David?
Oh, yes.
Yeah. So I've got a little note there about pricing errors. You have immediate reporting obligations for any material pricing errors or material failure to comply with your methodology. And so that may be incorrect interest rates that were applied to benefits, incorrect unit prices. It may be from one of your fund managers had an incorrect unit price and you were notified. So you've got that reporting obligation to let the FMA know as soon as reasonably practical after becoming aware. And in all cases, make sure your LIT is aware straight away. And often the LIT is wanting to engage directly with the FMA on it and leading the charge.
I think you made a good point there, Ree. Often this will be done to you, often as restricted workplace savings schemes trustees. It will be an error that's been made, say, at the fund manager level at their pricing, which then might flow through to impact on, say, your unit pricing or just the values that you've put on member accounts. That can be a pricing error. that you thought it was worth one thing, you're then told actually that was wrong, it was a different thing, and then you think, well, hey, is this a material pricing error? What do I need to do about it? It can also be as simple as the way you've calculated pension benefits or commutation values. Actually, if you've had an incorrect methodology of the way that's been worked, then maybe you've got a pricing error. Just be aware of it's not just an administrative mistake that you need to fix. You may actually have a regulatory obligation when there has been a muck-up in calculations. Licensed independent trustees, we have talked about them a little bit, and the point there, a LIT is the same as every other trustee, only different. And bear in mind this, as usually it's going to be your independent director sitting on the board of trustees of the corporate trust board, right? Key thing to bear in mind, we have heard this, I guess one of the myths that we constantly need to dispel, is whilst your LIT is the one that's got, I guess, the tick from the FMA as to their competency, their professionalism, what they are expected to know more about the operation of a scheme and what your obligations are than every other director on the trust board. But all of you are in it together, you are all responsible. A trustee cannot abdicate decision making to the LIT, right? That it's say you might be informed or actually benefit from the knowledge that the LIT brings to the boardroom table, but they are not the ones who are dictating, and all the other trustees, I guess, just acknowledging and going along with what the LIT thinks. Everyone is actually providing valuable input into a board of trustees, but not go into this too much because this will be the subject of the governance module I do encourage you all to look at. But bear in mind, a LIT has no greater power under the FMC Act compared to any other director or trustee. They have greater obligations, so there's a separate set of regulatory burden that is placed upon a LIT. It's why they need to be particularly conscious of any issues, in particular some of the things that Philippa talked about, related party transactions, pricing errors, etc. So they have obligations to report, but they do not have any greater power. It's not a case of, well, they can outvote every other trustee. You're all in it together. I think it'd be fair to say, Philippa, that the governance dynamic for LITs is evolving. And I, for one, do intend to drop into the governance module and just hear what our resident expert LITs have to say about their views on governance. Fair to say there, but do make use of your LIT within your scheme. They're all, I guess, very experienced, quite a small cohort within New Zealand of people who have been given the tick by the FMA to be licensed independent trustees. So utilise their expertise. They are part of the gang to administer your scheme, but you are all doing that together. Right, we're just conscious of time and not want to keep you too long. Just touch over some other regulatory obligations that you will be confronting as a trustee. We have got Privacy Act, obligation of the Privacy Act, overlays every commercial enterprise within New Zealand. Super schemes, workplace savings schemes are no exception. It will dictate your control, your collection, storage and disclosure of member details. Just look out for information sharing. Things that might seem quite innocent actually could come within the Privacy Act and will be regulated by it. With the new Privacy Act coming into effect on 1 December 2020, there are additional reporting obligations if you suffer a privacy breach. So bear in mind there will be some extra rules if you do inadvertently leave your full list of member details on the train when you're going home one night. Actually, that becomes a privacy breach, right? You're leaving personal information around. Key thing is don't do that and make sure you're careful, very mindful of your the processes you've got in place to ensure any information about members of the scheme is being kept securely. As many other aspects of the commercial world, as schemes, you are subject to AML obligations. There have been some quite significant pieces of relief for employer schemes, and a lot of schemes will operate under a ministerial exemption to provide some practical relief from the full impact of the anti-money laundering legislation. It is generally, workplace scheme is regarded as low risk of money laundering, But bear in mind, if you think, well, this is, why should I be concerned about this at all? Money laundering is not possible through my scheme. The other aspect of AML that we hear less about is actually countering the financing of terrorism. And of course, even if it's not dirty money in terms of proceeds of crime, etc., anyone can be applying funds for financing terrorism. And that is the other angle of the AML legislation, is why it's there, why there are verification of ID obligations, just something to make sure we've got covered off within our scheme, and that whatever obligations you have got are being observed. Some other regulatory obligations, again, just whiz through there. The Human Rights Act does apply. Basically, do not discriminate against people on prohibited grounds. Probably preferably don't discriminate against anyone on any grounds, but there are a set of prohibited grounds, right? Age, disability, sex, gender, religion, ethnicity, etc. You might think, well, how's that going to happen? Where it will actually hit the rubber hits the road is when you're exercising discretions around, say, enhancing benefits or granting hardship relief or paying out death benefits. That's where the Human Rights Act really comes into play. Most schemes, all schemes should have been cleansed so that they are compliant with the Human Rights Act. It's just down to the operational side, just to be wary of the way you're exercising discretions, in particular, that you're not exhibiting a breach of that legislation. We've also got the FSP Act, full name, Financial Service Providers Registration and Dispute Resolution Act. That governs your engagement with your dispute resolution scheme, as well as your overarching registration obligation, which is different to the registration obligation for your PDS and your offer documentation on disclose. Right? That's all about the scheme and its offer, but you as a scheme also need to be registered on the FSPR, which is the Financial Service Providers Register, which is different to the Disclose Register, right? That's just public, where information is publicly recorded about the scheme. Basically, the scheme trustee as the provider of that scheme. Last one, just touch on their Financial Advisors Act. There is wide relief for employers, so generally it won't impact upon most schemes. And there was some great relief that has been brought into the regime for employer involvement in relation to schemes that are available through the workplace. The regulatory regime for Financial Advisors Act does come within the FMC Act from 15 March 2021, when the Financial Advisors Act will disappear. It's very similar type obligations as far as a scheme is concerned, just a new licensing regime for financial advice. Tax. We tossed up whether we'd go into the detail of this, and basically just headline bits around the text there. Neither Philippa nor I are tax advisors. Give some headline bits. Generally, employer contributions to tax to schemes do have ESCT deducted from them. Various rates for the way schemes might be taxed, whether you are a portfolio investment entity or not, is the key differentiator there. And of course, when you pay a benefit out from a scheme, it's not subject to tax under our tax exempt model that schemes operate under.
Actually, there's just one more point I'll add there, David. If you're making any changes to your investments, it always pays to speak to your tax advisor and just let them know of the intended change so they can consider if there's any taxation implications and also the appropriate timing, because sometimes you get caught in when you were intending doing your transaction.
Which goes back to that earlier slide about who's involved in the scheme, and the point raised about communicating and talking with it. But you're absolutely right. You make decisions. Your tax advisors are your friends in this. Just make sure they're aware of any changes you're making around the investment side, just to make sure you don't get caught out, right? Let's think governance. So the trustee's role in looking after schemes, it is an evolving thing. I think we are constantly improving things there, and that is the subject of a standalone model that module that I do encourage everyone to look into. And that is all that we had to say on our introduction to trusteeship. And Philippa, any final words from you? I'll leave you to wrap up, eh?
Okay, thank you. as mentioned earlier, this is the first module in the initial 3-part trustee training series, and we'd encourage you to look out for those other foundation modules, being the basic governance, and that will include a little bit more on monitoring and the risk side of things, and also introduction to investments. So thank you for your time today. We trust the information has been useful, and that it will also be useful for new trustees coming on board. We also welcome your feedback, and this can be provided direct to the FSC, or you could contact David or I with that. So happy trusteeship. Enjoy.
Thanks all. Cheers.